So I've been trading for almost 5 years now, and I've only just started to realize how important risk management actually is and the nuances and the math behind why it's so important. In this video, I want to show you the two things that you need to do before any trade. Those two things are as follows. One, calculating the leverage you need to determine the position size stays the same for every trade. The second thing is that you're going to want to simulate the entire strategy a bunch of times so that you know what to expect, how much the variance is going to be between your results so that you don't get wiped out of your portfolio just through psychological torment. All right, let's talk about leverage, what it is, how it works, and why it matters so much in your trading journey. Now, leverage is the most appealing thing when you first get into day trading, I think. And it's important to manage your addiction to it, honestly, because it is crazy. You can basically take $100 and put 10x, 100x. Now you're trading with $1,000, you're trading with $10,000, and you are getting liquidated in one minute candle wick that just takes you out immediately. Sometimes your trade goes in the right direction for days even, and the price, of course, retraces. The market is after you, it's chasing you, and it's tough, man. It's a crazy business we're in. So let's talk about it and how we can calculate the amount of leverage that is safe, the amount that we want to risk per trade, and work backwards from there to calculate the leverage. So the first thing that you're going to want to do is you pull up your chart and you draw some lines. Of course, you're going to create a theory, a strategy that you have, and risk that you want to take. You have a target in mind of where that instrument is headed. So no matter how you do that, whether it's a fair value gap or maybe you're trading on diagonal lines like me, maybe you use ICT strategies at the open of every New York session. Whatever it is, you have to look at that chart and determine where you're taking the entry, why you're doing that, of course, but also where you're putting your stop loss. And that distance, that percentage, is how you're going to calculate what your leverage is going to be. So in this example, we are looking at a Bitcoin chart, and Bitcoin is going to bounce off this line. That's my belief. Doesn't really matter why I think that, why I drew this dumb fucking line in the middle of the chart, but I did, and I'm trading it for better or for worse. All right, so let's jump into the chart and see what that looks like. If I look down, my stop loss is 0.5% away from my entry. When it gets past there, I'm not interested in being in this trade anymore. What I am going to do is take that 0.5% and run some calculations, complex math on my calculator. I'm going to pull that up here, and I'm going to take the amount that I'm willing to lose on each trade, a percentage of my portfolio. So let's say that is 5%. I'm going to take 5 and I'm going to divide it by that 0.5%, which is my stop loss. And that's going to give me 10. So that means if I put my leverage at 10 times multiplier, when the price moves down 0.5%, I'm going to lose 5%. You guessed it. It's really simple. Like if you imagine you're on 10 times leverage and the price moves down 1%, think you just lost 10%. 1 times 10 equals 10%. So we're just doing simple math. Sometimes it gets confusing when you're using these half percentage points and stuff like that. But that's the calculation. So I'm just going to throw that up on the screen here. You take the risk on your account as a percentage point, just straight number, 5. divide that by the percentage point of your stop loss. The other important thing when we're doing these strategies, so obviously we didn't calculate the take profit yet. I'm going to assume you guys kind of have that in mind when you're trading. Me, I am fall victim to this all the time, but I take trades that have a small stop loss and I'm shooting for the moon. I want to ride this Bitcoin run all the way up to new all-time highs, and taking these trades are sometimes 50 to 1 risk to reward. It's a fun way to play the market. It's a fun strategy to implement. It works sometimes, but it's a lot more like gambling. And I'm going to kind of break down why that's the case, and also how to find a risk reward strategy that actually works for you. Okay, we've logged in here to thankyousomuch.com. It's free to use, and you just have to sign up. We're on the trade return calculator, which is going to simulate the strategy that we're using, no matter what that is. Of course, we can use any strategy, but we have to have some idea of how that's going to work for us over a certain amount of trades with a certain risk profile and win rate. So we're going to risk 5% per trade. We're going to use, for this example, 3 to 1 RR, which is pretty typical of what a lot of YouTube gurus will tell you. The win rate for this, let's make it 30%, which gives us quite a bit of an edge against normal probabilities. We're going to do this for a period of 100 trades. So let's say over the course of a year, we trade twice a week. We're going to get about 100 trades that year. And we're going to run the simulation. The first result is going to be a net loss of 52%, which is pretty bad. I mean, we don't want that outcome, of course. What if our portfolio was much larger? We would be pretty upset, I think, if over the course of a year we lost that much. Let's run it again. In this scenario, we have 1,100% gain. We've got over $1,200 in the account. You can see a fairly steady equity curve. Looks like around the 90th day, we really shot up and doubled the account. That kind of volatility isn't exactly a good sign for a strategy. We can come down here and look at how the outcomes were simulated. You can kind of gauge your ability to handle this strategy, watching your P&L go up and down overall. Can you handle that mental load? Can you handle the swings? You have to determine that for yourself. So we can run this simulation a bunch more times really quickly and get a feel for the different types of results that we might encounter. It's quite varied between a 10x on the account and a small 2% gain, sometimes 600%. So it varies quite a bit. Not often is it resulting in a loss on the account. So you could say that this is a healthy strategy over time. I think that if you look at it in a long-term way, this is a really great strategy. Now, a lot of people, like I said, are playing crypto in the meme cycles. They're buying coins and trying to hit that 100x. Like I was saying, sometimes I'm going for a big risk of, oh, sorry, not the risk. We'll leave the risk at 5%, but I'm going for a big RR of 50 to 1 sometimes. And that is tough. It's really tough to do. I think I'm only right about 5 to 10% of the time at best. So let's say the win rate's 5, and we'll say the number of trades, we're only going to be able to take 30 a year. So just a couple times a month on these type of trades. And you can see big loss. Quite a weird chart to look at, but that's a 200% return. A net loss again, a net loss again, net loss. We got a 10x on the account on this result. Another net loss, big one here. We really blew up this account. You can see again a volatile end of the session there. The last few trades, 28, 29, and 30, we really 4x the account in that one trade. Another loss, big loss, another big gain. So you can see the results again are varied. You have to determine whether you can handle that psychologically. That's the biggest part of trading. And remember that for these 30 trades, every time I have to risk exactly 5%. That means I have to know the leverage that I'm using, know how much this coin could move against me. If a coin is a meme coin and it can drop 30% in a day, you can't risk your whole portfolio on that coin because you're going to liquidate the whole thing. It won't enter your stop loss properly, no liquidity. So on something like that, if I want to risk my whole $100 account and I want to lose $5 every time, so maybe I'm just putting $5 into the meme coin rather than putting the whole thing and trying to only take a 5% drawdown. You see what I'm saying? So there's a lot of ways to look at the risk, a lot of ways to look at each trade size, but what's important with this simulator is to know that every trade has to be the same size. That risk of 5% has to stay the same across the board, no matter how much leverage you're using or what coin you're getting into. And I hope that the first part of this video helped show you that calculating the leverage is really easy. You just have to do that one calculation, divide your risk divided by the amount of your stop loss. All right, I hope that helped you guys. Again, you can go to thankyousomuch.com. Got lots of information there, and yeah, check it out. Thanks again. See you guys.